question of how to construct a payoff table. How to construct a payoff table. And of course, we shall go ahead and look at how we shall be utilizing the rules of maxi-maxi, maxi-mini, expected values to help us make optimal decisions. So with me here, I have an ACCA question, which is very important. So we are told a cement company is a company specializing in the manufacture of cement, a product used in the building industry. The company has found that when weather conditions are good, the demand for cement increases since more building work is able to take place. Last year, the weather was so good and the demand for cement was so great that cement company was unable to meet demand. Cement company is now trying to work out the level of cement production for the coming year in order to maximize profits. The company doesn't want to miss out on the opportunity to earn large profits by running out of cement again. However, it doesn't want to be left with large quantities of the product unsold at the end of the year, since it deteriorates quickly and then it has to be disposed of. The company has received the following estimates about the probable weather conditions and the corresponding demand levels for the coming year. So we have weather, good, average, poor. We have probabilities, and then they have given us demand. Each bag of cement sells for $9 and it costs $4 to make. If cement is unsold at the end of the year, it has to be disposed of at a cost of $0.5 per bag. We are told the cement company has decided to produce at one of the three levels of production to match forecast demand. It now has to decide which level of cement production to select. So out of that, they want us to construct a payoff table to show all the possible profit outcomes for how many marks? 8 marks. For 8 marks. So ladies and gentlemen, this is quite a straightforward question. It's quite a straightforward question. I'll come here, mention payoff table. So we have our payoff table. So this payoff table, what do we have? We have, ladies and gentlemen, here, our alternatives. We have our alternatives here, and then we have our states of nature there. States of nature there. States of nature, these are those probabilistic events. Those probabilistic events that are uncontrollable. The probabilistic events which are uncontrollable. Which are uncontrollable. That's why they have probabilities. Alternatives, ladies and gentlemen, these are the options which are within our control as the investors. Like in this particular case, our proper alternatives here will be the supply. How many bags of cement do we supply? So of course, supply is connected with production levels. So it is us to decide how many bags of cement do we supply to be able to meet the demand which is given outside there. And we're going to produce at one of the demand levels given there as per that table. If you look at that table, good will lead to a demand of 350,000 bags, average to 80,000 bags, poor 200,000 what year bags. And since we do not know how many bags of cement will be demanded, we have to contemplate to produce any of those three demand levels. Our production has to be at any of those three demand levels. So our supply has to match the demand. So supply, ladies and gentlemen, we have here 350,000. I'll just try this in terms of thousands. We have 280,000 bags, and then we have 200,000 bags. So of course, supply must always be equal to demand. So whatever you have here as your supply should also be on your demand side. So states of nature, these are the demanded quantities. the demanded quantities, which could either be 350, we have 280, and then lastly we have 200. Lastly we have 200. Lastly we have 200. Lastly we have 200 there. So remember, ladies and gentlemen, we said that these states of nature are supposed to be probabilistic. The states of nature are supposed to be those events that you can't do what? That you cannot control. That you can't control. So you get some books, of course, interchange. You can interchange them. At the end of the day, we'll get the same answers. You'll have some students saying here we have demand, other students saying we have supply. It doesn't really matter. Or you do it the way I'm doing it here. So, ladies and gentlemen, a payoff table basically is a profitability table. So we want to compute profits. Like now here we have cell number 1. In this cell number 1, I have to interpret this cell number 1 very well. In this cell number 1, I'm going to supply 350,000 bags of cement. And I can see the demand is 350,000. I'll stop making use of thousands. So I'll be talking of 350. I know that my bags here are in form of what here, thousands. So we are saying that for cell number 1, we have supplied 350. And the demand happens to be what here? 350. So there is perfect match. So and as such, we are going to have 350 bags of cement being sold. And if that is the case, then my sales will be 350. My sales will be 350 times the selling price per bag. The selling price per bag. The selling price per bag, if you can look at that question, the selling price per bag in paragraph number 2, they have told us each bag of cement sells for 9. So in this case here, 350 times 9 minus 350 times 4. The same paragraph has given us the cost of supplying. The same paragraph has given us the cost of making each bag. So it is 4 like that. Now come to cell number 2. Cell number 2, ladies and gentlemen, what are we able to see in cell number 2? This is quite interesting. Cell number 2, ladies and gentlemen, what I'm able to see here is a situation where I supply 350. But how many are being demanded outside there? Only 280. So remember, whenever I want to know how many units here will be effectively sold, how many units shall we effectively sell, I'll always be comparing the demand vis-a-vis the supply. And of course, the lower prevails. The lower prevails. Like now here, we're supplying 350. And how many are being demanded? 280. So ladies and gentlemen, what will happen here is that we can't force people to buy what they don't need. So in this case here, they'll only consume what they demand. So we shall only be able to sell what here? 280. So 280 at what price? At what selling price? The selling price is 9. But remember, ladies and gentlemen, ourselves, we are taken down there to the market, 350, and produced 350. Remember the production and the supply is 350. So minus the cost of supplying 350, which will be 350 times 4. Ladies and gentlemen, also there is something that I have to deduct. I can see that there is an oversupply. There is an oversupply. Here, we supplied 350, but how many have been demanded? 280. So there is a difference of 70. 350 minus 280. Always try to rely on your calculators. Try to rely on your calculators. Try to rely on your calculators. Always use your calculators. However simple something looks like, just go there and press 350 minus 280. I can see, ladies and gentlemen, that we'll have 70 units which we shall not be able to sell. And what is the policy of not being able to sell? What have they told us about the policy of not being able to sell? If you look at this particular question, paragraph number 2, where they gave us information about the selling price of 9, where they gave us information about cost of production of 4, they continued there by telling us that if cement is unsold at the end of the year, if cement is unsold at the end of the year, it has to be disposed of at a cost. We have to go and throw away. We take these 70 bags of cement to some dump site. So we're going to throw away, and this throwing away is going to cost us. And the cost of disposal is 0.5. So in this case here, there's 70 bergs, the 70, so minus 70 times 0.5, the 0.5 there being the cost of throwing away one berg, throwing away one berg. So go to the next cell. This next cell, how do we interpret it? I can see the supply is 350. How many are being demanded? I can see it is 200 bags that are being demanded. So demand is lower. When demand is lower, so demand becomes the effective sales quantity. So 200 will be sold times 9, minus, of course, we must have produced 350 in total. So minus 350, 350 times what here? Times 4, minus the cost of disposing the extra units. Extra units here, 350 minus 200. So you're talking of 150 bags of cement, which have to be thrown away, and the cost of throwing each bag is 0.5. The cost of throwing each bag is 0.5. Now, ladies and gentlemen, come to this other argument. Very important argument. Very important argument. This is a situation where we have supplied how many units here? 280. This is cell number 4. This is cell number 4. Under cell number 4, we have supplied 280 bags. But how many have been demanded here? 350. 350. So, of course, I told you, to be able to get the effective number of units here that will be sold, you compare the demand vis-a-vis what here, the supply. And, of course, work with the lower. So, in this case here, of course, we know that we have 280, but the demand is higher. We can't sell air. We can't sell what we don't have. Ladies and gentlemen, in this case here, we'll talk of 280 is what we shall sell. So 280 times our usual 9. We supplied, of course, 280. We supplied what we produced ourselves. And we know that the cost of production is what here is 4. But now, ladies and gentlemen, we happen to be having some customers who will be disappointed. We happen to be having some customers, how many of them? 350 minus 280, about 70 customers who will go home without a bag of cement. Ladies and gentlemen, these are customers who had come asking for cement, which we don't have. In most cases, ladies and gentlemen, you'll be given goodwill to be lost for every unit you are not able to sell. For every unit you are not able to sell, you'll be given a cost of goodwill lost. Have they given us any information about goodwill lost? Let us read paragraph number 3. Paragraph number 3, there is really nothing much they're telling us there. Cement company has decided to produce at one of the 3 levels of production to match forecast demand. It now has to decide which level of cement production to select. Each bag of cement sells for 9 and the costs 4. There is no goodwill lost there. Perhaps you could again start from up there to be able to understand even the question better. We are told cement company is a company specializing in the manufacture of cement, a product used in the building industry. The company has found that when weather conditions are good, the demand for cement increases since more building work is able to take place. Last year, the weather was good and the demand for cement was so great that cement company was unable to meet the demand. Cement company is now trying to work out the level of cement production for the coming year in order to maximize profits. The company doesn't want to miss out on the opportunity to earn large profits by running out of cement again. However, it doesn't want to be left with large quantities of the product unsold at the end of the year, since it deteriorates quickly and then has to be disposed of. The company has received the following estimates about the probable weather conditions and the corresponding demand levels for the coming year. So they have given us that information there. And of course, you can see there is nowhere where they have given us, ladies and gentlemen, information to do with goodwill lost for disappointing any customer. So there is nothing like goodwill lost. So that is okay, and that now marks the end of this particular what here we shall be able to compute these values later. So come here. Here, this is a perfect match scenario. We produce 280 and 280 are demanded. So we shall be able to sell 280 exactly times 9 minus 280 again times what here? 4 minus the cost of producing. cost of supply. Come here, ladies and gentlemen, this is very interesting. This particular cell, we are able to produce 280, but how many are demanded? Fewer. So we shall sell the fewer units which are demanded. So here we shall sell 200 at what here? At 9, minus the cost of supply. Of course, we had supplied 280. So 280 times the cost of supply is 4. Ladies and gentlemen, here I can see myself perishing with some cement. We had supplied 280, but how many have been bought? 200. So we have 80 extra that I'll perish with. 80 which will be left unsold. So the 80 which will be left unsold, ladies and gentlemen, shall be disposed of at a cost. We shall take this to some dump site at a cost of 0.5 per bag. So come to the last row. Last row, we are producing 200, 350 are being demanded. So in this case here, we shall end up selling what here? Whatever we have, because now demand is higher. Unfortunately, in this particular question, there is nothing like disappointing anybody. There is nothing like, there is nothing like a disappointment fee. So it will be 200 times 9 minus the cost of supply, which will be 200 times 4. Now I'll be able to move with speed. Like now here, it is 200, ladies and gentlemen, units which have been produced, but demand is higher. So again, we sell whatever small we have. 200 times 9 to get revenue minus cost. Cost of supply will be 200 times 4. Come to the last cell. The last cell, what do we have? It's a perfect match thing. The last cell, ladies and gentlemen, I can see we've produced 200 and the demand is 200. So perfect match, sell 200 times 9 minus 200 times the cost of supplying, which is 4. So ladies and gentlemen, now get your calculator and give us these figures. Give us these figures. So we start with the first figure. So the first figure, what do we have here? The first figure. The first figure, we have 350 times 9. 350 times 9 minus 350 times 4 equals, which will give me 1750. I can comfortably delete this and write there 1750 like that. Of course, my figures are in terms of dollars, thousands, because of the demand, which was in terms of thousands. So come to the second one, we have 280 times 9 minus the cost here, 350 times 4, 350 times 4 minus 70 times 0.5, 7 times 0.5, which gives me 1085, which gives me 1085, comfortably here, 1085. Go to the next one, ladies and gentlemen, it's 200 times 9 minus 350 times 4 minus 150 times 0.5 equals, what are we able to see there? 325 is my figure. 325 is my figure here. 325. So come there, 280 times 9 minus 280 times 4, which at the end of the day will give me 1400. So we have here 1400. Go to the next one, 280 times 9, right? Minus 280 times 4, which at the end of the day gives me 1400 as well. This gives me 1400. So I have 1400 there. The last one for this row is 200 times 9 minus 280 times 4 minus 80 times 0.5, which will end up giving us 600 and what here? 640. These will end up giving us 640. Come to the last row, 200 times 9 minus 200 times 4, which will give us 1,000. So this is 1,000. So I can see all these are the same. So we shall basically have what here? 1,000 for all of them. Down here we have 1,000, 1,000, 1,000, 1,000. 1,000, 1,000 like that. 1,000, 1,000. So ladies and gentlemen, we've been able to finish part 1, which needed us to ascertain, the payoffs. That is okay. Now let us go to the second part. So the second part, what do we have for the second part? So the second part, ladies and gentlemen, the second part, they want us to determine the level of cement production the company should choose based on the following decision rules. Number one, maximini. So maximini, what do we understand with this maximini? If you can remember, maximini stands for what you're maximizing minimum payoffs. Maximizing minimum payoffs. It is also known as the best of the worst strategy. It is also known as the best of the worst. The best of the worst strategy. And we normally start with this second bit. So what we shall do is to come and create a column here for the worst. So remember that maximini is normally used by individuals who are conservative in nature, pessimistic investors. And that is why we are starting with the worst. Pessimism is all about worst. So like now here, ladies and gentlemen, when you tell this person that if you supply 350, there are three possible profits. It's either you get 1750, 1085, 325. Because this person is a pessimist, he can't wait even for an average. He can't wait for the best. Pessimists always believe that life doesn't work in their favor. They always believe, ladies and gentlemen, that life is never good for them. So in this case, they'll always expect the worst. So you come and pull the worst here, which is 325. 280, give them the three scenarios, they'll pick 640. 200, give them the three scenarios, they'll come and pick what somebody there, they'll come and pick 1,000. They'll come and pick 1,000, the lowest, you pick the lowest there. Now, having picked the worst scenarios, ladies and gentlemen, you'll come and now make a decision on the basis of the best of the worst. So among us, the worst, the best of the worst is this 1,000. So 1,000 is the best of the worst, the best among us, the worst. And if that is the case, then we are telling them that using maximini, the company using, so in conclusion here, using maximini, the company should supply. The company should supply 200. Remember, these were in terms of 1,000. So 200,000 what year? Bugs. The company should supply 200,000 bugs. 200,000 bugs. 200,000 bugs. 200,000 bugs. Ladies and gentlemen, please go to the next question. Go to the next question. Next question, they want us still in part B to use maxi. To use maxi. So maxi stands for what in full? Maxi, ladies and gentlemen, is maximizing maximum payoffs. It is that criterion that is normally used by individuals who are very optimistic. Optimistic individuals normally use this criteria that we call best of what year? Best of the best. So you're saying that maxi is also known as best of the best, is also known as best of the best. So what I'll do, I'll come and delete this column for worst, having exhausted using it. So I will come straight away here and create a column for the second parameter for what we are calling best. So best, remember this person is quite optimistic, is very optimistic actually. So when you tell him that if you produce 350, you could either get 1750, 1085 or 325, to them, they have always the best light shining towards them. That is what they believe. So they'll always expect the best. They'll always expect the best. So like now here, this guy here will expect the highest, you'll expect 1750. Here, you will come and expect 1400. Here, you will come and expect what here? 1,000. Having gotten the best scenarios, now what we need to do is to come and give them the best amongst all of them. So the best amongst all of them is this 1750, best of the best. This is what we call the BB, best of the best. Now, having selected best of the best like that, now I can comfortably see where the corresponding item is. The corresponding item is here, 300 what here? 50. So we are telling, ladies and gentlemen, this particular person here that using Maxi, the company should supply, I can see the corresponding quantity is 350,000 units here, or bags of cement. So I hope that is clear. And please don't forget that RCM has great online classes for ACCA, great online classes for CPA. Please take a step of helping us by sharing this particular clip on social media. Just share it. Share this clip. That is the only good thing, greatest thing that you can do to your neighbors, to your friends who are struggling in terms of getting quality materials, training materials over this COVID season. Thank you. Now, the last question here. The last question, ladies and gentlemen, they want us to give them the expected value. Expected value means average. Expected value means us making use of what here? Probabilities. And fortunately, you can see they have given us probabilities of the highest demand on that table. You can see here, they have given me the highest probability. The highest probability for the highest demand here, not highest probability, but highest quantity probability, 0.25. So here, this is 0.25 probability. How about the one of 280? The one of 280, I can see it is 0.45. It's 0.45. And then lastly, I have the one of poor, 0.3, like that. So what I need to do is to come here and create a column of expected monetary value. Create a column of expected monetary value. Create a column of expected monetary value. So expected monetary value, what shall we be doing? We shall be taking our values here, multiply them with their corresponding what here probabilities. So you take like 1750 times 0.25 because you're not so sure which one between the three will prevail. So it is this times this plus this times that, etc. So ladies and gentlemen, here we are. We'll talk of 1750. So you're getting EMV for this first alternative. So 1750 times 0.25 plus 1085 times 0.45 plus 325 times 0.3, which at the end of the day gives me 1023.25. From there, ladies and gentlemen, we have 1400 times 0.25 plus 1400 times 0.4 plus 640 times 0.3, which will end up giving us 1102. And then the last one will be 1,000 times that plus 1,000 times 0.45 plus 1,000 times 0.3, which will end up being 1,000 like that. Now, ladies and gentlemen, having gotten our